Good afternoon, Mr. Thomas. Due to the restrictive nature of the global pandemic, we have decided to record your investment plan that we had formulated in alignment with your preferences, circumstances, and the information you have provided through both our online discussion and questionnaire. In order to provide clarity throughout the proposed investment plan, we have provided a brief breakdown of what will be covered in this plan. The following areas will be assessed: your goals and expectations, your risk profile, investment objectives and constraints, synthesis, analysis, and prioritization of our numerous discussions, any potential client trade-offs that may surface, our investment recommendations, our advised asset allocation and product selection, our chosen product selection, the application of our chosen risk assessment method, and the monitoring of the investment advice process to ensure coherency and strength in our client-advisor relationship. The first stage of our investment proposition is to encompass a holistic approach that allows for structured advice to be administered. When formulating your investment plan, we have taken into consideration both your personal and financial circumstances in order to structure a suitable investment plan in alignment with the standards of the Financial Conduct Authority. These factors include affordability when identifying suitable investment products, understanding the extent of risk associated with selected investments, and most importantly, providing clarity on how our proposition meets your financial goals. Throughout this presentation, we will explain coherently the processes involved in formulating your investment profile and investment propositions that we are proposing. It is very important to us that there is a joint understanding of why and how we have made certain decisions, as well as clarity in the financial terminology that we use throughout this presentation. A fundamental aspect of the investment proposition is understanding both your risk tolerance and capacity. Risk tolerance allows us to measure the loss that you are able to bear emotionally and psychologically. Factors that play a role in this include existing financial commitments, timescale, current wealth, and the proportion of your wealth at risk. Whilst risk capacity refers to the loss you are able to bear before it has an actual impact on your lifestyle or financial commitments. These factors are a little bit more difficult to gauge, so in order to address your risk capacity, we have decided to conduct an online discussion to pinpoint any preferences you may have when it comes to investing. So, in order to achieve optimum suitability and direction when exploring potential investment products, we have conducted an online discussion via Zoom in order to gauge your attitude towards certain types of investments and/or any ethical considerations that you may have, any past experiences you may have in investing, your key aspirations in the short term and the long term, your key priorities and emotional circumstances, and to understand your risk tolerance in order for us to advise you in alignment with your risk profile. At Incrementum Financial Services, we are aware that either personal or financial circumstances may change and will act accordingly to address any immediate changes through monitoring the investment advice process. So, we have received and analysed the results from the questionnaire that we had sent to you via email that provided us with an insight into your financial position. From this, we have been able to understand the extent of your risk capacity, which enables us to gauge what risk really means to you. This then allows us to advise you accurately in order to maintain a motion of fairness and good faith throughout our long-term relationships. As a result of our prior Zoom meeting, the following inferences were made. From a personal stance, we have inferred your name, which is Joseph, your age, 32, your marital status of single, your occupation as a warehouse operator, and any underlying medical conditions that you may have, which is none in this case. Additionally, we have been able to obtain the following financial information to better understand your current financial position. The key information identified includes assets of £15,000, liabilities of £65,000, a gross income of £24,800, current expenses of £12,500, and you're receiving an inherited amount of £89,560. From the information received, we will then look to strike a balance between your risk capacity and tolerance to clearly identify whether your requests are mutually incompatible or not. It must be raised that there may be situations in which may not be perfectly in alignment with your requests. This is known as a trade-off. Trade-offs are a common factor of a financial plan and may involve you pinpointing what's most important to yourself. However, before we address this point, we have formulated a risk profile centered around our online discussion and results from your completed questionnaire. It's important to make you aware that any form of investment carries some form of risk, and for us to make a return on your future investments. Thus, some risk will have to be adopted. As a result, we will seek to manage the risk that is incurred rather than avoid it. We are also very much aware of the financially pressing times individuals are experiencing as a result of COVID-19 and have fully implemented these considerations when both producing your risk profile and selecting suitable investment products. In order to clearly understand the nature of your risk, we had addressed your types of investment preferences via our online discussion, These considerations include that you are not concerned with high-risk investments, you are not interested in low-tax investments, and taxation efficiency is a secondary concern to yourself. In combination with our findings from your goals and expectations and our assessment of your investment preferences, we have concluded that you as an individual are categorized as risk-averse in nature in terms of investing. What is meant by this is that you are not willing to take on high-risk investments, which we'd identified through the online discussion. Subsequently, we have selected a range of investment proposals that match both your risk profile and wants and aspirations. However, before we come onto these, we need to provide synthesis and clarity in our findings.
In this section, we will look at the investment objectives and different constraints. The main objectives are return requirements and risk profile. The main goal for the client is to invest £89,560 for growth in a horizon of between 5 and 7 years. The main constraint is that the horizon is 5 to 7 years. This assumes a longer horizon, which means that there is a possibility that the client could be exposed to short-term validity. This means that the investment can gain more risk over this period of time. Another constraint is liquidity. As this is a longer-term investment, the client is seeking capital growth. This means that liquidity could be poor in investments like property. In terms of tax, with the client's current occupation as a warehouse operator, the tax from the investment will be at 20%, as the client is in the lowest tax bracket. So we know that Joseph is looking for capital growth with a low risk attached in a horizon of 5 to 7 years. Joseph is in a pretty strong position at the moment in order to invest his inheritance. He has no health conditions or ethical concerns. Due to working as a warehouse operator, he pays a base rate tax at 20%. He's also single and has no parental responsibility as he doesn't have any children. However, weak points of his position are that Joseph has no prior investment experience, and we have identified that he is risk adverse, as well as the fact that he has liabilities totaling £65,000. Our company has carefully considered the key factors that drive the investor's reasons for wanting to capitalise on their inheritance. Although they are opposed to high-risk investments, serious consideration should be given to a split investment, 80% into a low-risk investment, maybe property, but then we would propose 20% into a higher-risk investment, like a venture capitalist trust or hedge fund. There's a risk that you get back less than you invest. However, the longer you leave your investment, i.e. the 5 years, the less the risk and the greater the return, which can provide the investor with the higher capital growth they are seeking.
Client trade-offs. As he currently lives with his friend, his household requirements aren't of high priority, but he would be hoping to move out in the next 5 to 7 years. Therefore, he is looking for a longer-term investment. Secondly, his retirement plan should be considered, but this is of lower priority than previous. Investment recommendations. I suggest buying a small property or flat to rent out. This should ideally be in Liverpool, as it has the highest percentage yield on average in the UK. Property is also one of the most secure investments at the minute due to Corona. The rent will be a monthly income, which can then either be saved for retirement, used to buy a mortgage, or into a savings account. The average rent on a flat in Liverpool is £769 a month, which is equal to £9,228 per year. This ensures short-term needs will also be met. Using the average inflation of a property in Liverpool, the value of a property was £80,000 to start. This means in 4 years it would then be worth £101,000, which would only get higher with time. You will always have the choice to sell at any time. You have that flexibility, which ensures long-term needs will be met. However, the incomes will be taxable, and there is a slight risk of not having a tenant for a while, but with risk comes reward. Another disadvantage is time. Being a landlord can be a time-consuming job. You'll have to manage contracts, undertake maintenance, deal with disputes, sort out your taxes, and you'll need to spend time vetting prospective tenants. As good tenants won't cost you anything, but bad tenants possibly will. Another investment you could consider is a Help to Buy ISA, as you do not yet own a property. However, I don't believe this is the best path for you, as you'll not receive a monthly income, and so short-term goals will be impossible to reach. You'll also not gain as much profit compared to renting out. You won't have any freedom with the money you will need to buy your first home with it. However, since there is less risk, it might be something to explore if you're more comfortable, as the government will give you 25% of what you invest, up to a maximum of £20,000 a year. This would also be tax-free.
Hello, Joseph. Based on our analysis of your personal situation and your special requirements, we will customize your personal investment portfolio. First, based on your personal information, the result of our analysis is that you have a relatively stable career and stable level of income, and currently single, so you do not need to worry about the issues such as the household and children's education expenses, have any annual income sufficient to cover your expenses, and already have ability to saving money. The conclusion of our analysis of you are a conservative investor, so therefore we consider building a portfolio of high security and high liquidity investment for you. A conservative portfolio is usually divided into four parts: 25% for ISA accounts, 35% for saving accounts, 20% for current account, and 20% for ETF funds. Therefore, we can say that by diversifying your investment, we will reduce the risk of your plan. If an investment product has time or saving limits, we will invest in it separately as appropriate. So first, individual saving accounts. The British government introduced the individual saving accounts in 1999, which is exempted from personal income tax and capital gain tax. However, there is the deposit limit for each year. This year, the limit is 20%, £20,000. We will choose skipped 5 years fixed rate ISA for you. The duration is 5 years. Part of the balance cannot be withdrawn. Annual interest rate is 1.9%. At the same time, we will buy lifetime ISA for you. This is a long-term saving and usually 5 years in full compliance with your financial plan. The annual return is 1.1%. Saving account is among 35%. As a product of the highest ratio in investment portfolio, the saving account can avoid most of the risk, and the product is a long-term investment, and the annual interest rate is relatively high and among the saving products. Regular saver, zero deposit and long withdrawal. Annual interest rate 5% per year, and monthly deposit is £250, cannot be withdrawn in advance. And the second is the fixed rate saver. Annual interest rates 0.85% depending on the deposit period of 3 months or 3 years. And the current account 20%, taking into account your current personal situation. Based on your personal risks consideration, we hope that the demand deposit account can help you have a higher degree of flexibility. It will also be used as the reserve of emergency funds, and will also take into account that you may need to pay through discounts, utility, rent tax, and not. Nationwide flex direct annual interest rate 5% for first year and 1% afterwards. Monthly transfer of 1,000, no interest on deposit over £2,500. Santander 123 current account is 1.5% annual interest rate. Monthly transfer of £500, monthly fee £5 can enjoy 3% cash back. And the ETF fund investment 20%. We will buy the iShare MSCI UK ETF products for you. This is a AA rating ETF, targets industries such as the finance, consumer goods, energy, and materials. The index funds include HSBC Holdings, Vodafone Telephone Group, and Royal Dutch Shell that can discover and compare the index of some major stocks. As this year, epidemic has infected the UK's financial market, it can be concluded from the data. And this year, products price are much lower than market expectation. And we can use this as a long-term financial product. It is believed that the financial market still repair. The long-term the development of this product will have a strong potential. The 5-year product rate is 5.28% on average. So the conclusion, based on our above 5-year average return of the asset portfolio, the comprehensive return of the portfolio is 13.6%. The above is our investment portfolio recommendation for you. If you still have any confusion, you can refer to the portfolio mind map.
Hi, Joseph. Due to the current situation of pandemic, we had an online open discussion to assess your risk, of which you had mentioned that you are happy to try most type of investments. However, you do not prefer investments which have high risk and low tax. And we also need to monitor and review your investment plan just in case the changes of your personal circumstances the changes of investment aims and legislation and economy situation. So as for the personal circumstances, you might want to get married and have children in the near future. So you will need money for your family life. It is possible to reduce the amount for your investment, or you may also want to invest your money in some products which have a little bit higher risk to get a higher return. And as for your job, you may get promoted and receive a higher salary so that you will have more money to invest or buy new investment products. We also need to pay attention that what if you get ill or not feeling well? You may reduce your money for your investment to get treated, or withdraw your money in advance, which means you may need to pay penalty. It is also possible that you may want to change your investment aims in the future, like you want to try some new products, which are different from your old products in terms of the risk and return. It is also likely that you may want to change the investment term for a longer period, like 20 years, for your pension, since we consider the fact that you are 34 years old now, and there's a long time until you may retire. And as for the legislation and economy situation, there might be new legislations in terms of tax, so the returns on some products might be different. So you may want to change your investment choice to achieve your investment goals. As for the economy situation, we must consider some factors like inflation. For instance, you might want to invest internationally, or increase the investment amount in bonds which are linked to CPI to hedge inflation. So last but not least, we need to keep track of current investment plan to see whether these products perform as anticipated to achieve your goals and make adjustments in time. It is also important to pay attention to any new products which might have better returns at a lower cost, so that they can suit your investment goals better. Thank you, Joseph. So, Joseph, this is the investment advice we provide based on your personal circumstances as well as your personal investment goals. We will also review and monitor the investment plan to fit your aspirations better. If you have any questions about the investment strategy, or you want to make some adjustments, do not hesitate to contact us. We are more than happy to provide a suitable investment plan for you. And again, Joseph, thank you for taking the time.